All right, everyone. Boris Musheyev here. Welcome to another training video. And in this video, we're going to talk about a silent tax, which is called net investment income tax, right? And we're going to refer to it as NIIT, net investment income tax. A lot of people don't know it, but our federal tax bracket is an untrue, untrue unjust. I don't know about unjust, but like more untrue tax bracket, right? So a lot of people say, well, I'm in a 30% bracket. That's true. You could be 30%, 25%, 20% tax bracket. But, and a lot of you don't know it, being business owner, there's an extra tax that is being tagged along on your personal income tax return if you have an investment income, okay? A portfolio income, including your rental properties. And if you are over a certain threshold, and we're going to talk about that in a minute, then guess what? That tax gets added on automatically, okay? And without proper planning for this, and if you are that individual, you are paying that extra tax without electing out of it. And you can elect out of it, but only if you qualify for certain scenarios, right? And that is what we're going to talk about today. Because remember, tax planning is absolutely important, right? If you don't do tax planning, you don't sit down your tax planner and talk about these things, talk about your investment income, your other types of income, that you will never be able to be prepared. You will never be prepared for this type of tax because it's an extra 3.8% income tax, okay? 3.8% income tax on top of your income. A lot of people don't know this. A lot of business owners don't know this. But if you are making over $250,000 as a married individual, that tax is being tagged along on your taxes. So let's get right into it and let's discuss it. I'm going to go ahead and share with you my screen. Right, awesome. So like I mentioned earlier, right, we're going to talk about today the extra tax that the government imposes on you, which is called a net investment income tax. Okay, we're going to write it in letters, right? So net investment income tax. Okay, and we're going to refer to it as NIIT. Okay, NIIT, net investment income tax, is an extra 3.8% tax. Okay, this is an extra 3.8% tax on your investment income. Now, only certain individuals get to pay that. Most of the people that are on this call, at least watching this, are business owners. And your income is above threshold, right? And what is the threshold? If you're a single individual and your income is $200,000 or more, or if you're married filing a joint return and your income is $250,000. So terrible handwriting, guys, terrible handwriting. Or more, right? So that means if you make over $250,000 as a married individual, well, guess what happens? You pay that extra net investment income tax on any investment income that you have. Now that investment income includes, right, and we're just going to define some of them here. Number one is your rental real estate. Okay, rental real estate, capital gains, portfolio income, dividends. Okay, all of that is subject to 3.8% income tax. Okay, and also activity from the businesses that you do not materially participate, right? Businesses that not materially. So some of you might invest in startups. So some of you might be silent partners in some businesses. Well, guess what? You would have to pay the net investment income tax, okay? You would have to pay the net investment income tax of 3.8%, okay? 3.8% on that investment income. Or, right, or there's always like a calculation to it. And I'm really explaining to you so you can understand it. And then we're going to talk about how do you not pay it, what do you not pay, and what you need to do on your tax return not to pay it, right? So basically the IRS says, look, you're going to pay the lesser off, right, your excess above this income threshold, and we're going to assume the married filing joint for our example, okay? You're going to pay an excess of above the threshold or on your investment income. Let's say, for example, you had an investment income of $10,000, okay? And your overall income with your spouse, okay, is your adjusted gross income. We're going to say is $350,000. So you have to take 3.8%. And by the way, a lot of you don't know this because it is automatically being calculated on your tax return. Okay? Automatically. Bam, slap right there. And then boom, just gets added to your on your ordinary income tax rate. Okay? So you really have to take the lesser of your investment income or the excess above the threshold, right? So we have 10K and we have 100K. How do we get 100K? It's 350 minus 250. Okay, so really you're gonna end up paying 3.8% on the $10,000. Okay, does that make sense? Does not make sense? Does make sense? I don't know. So that will be $380 that you're gonna end up paying. That's pretty decent, right? You're like, oh, okay, great. Doesn't apply to me. Oh, that's great. But what if you have rental real estate? Okay, and you're going to sell that rental real estate. Well, guess what? If your rental real estate is not classified as an active business, okay, if your rental real estate is not classified as an active business, then guess what? This 3.8% tax gets smacked onto you. Okay, now let's talk about in what situations do you not pay net investment income tax? Okay, the situations that you do not pay net investment income tax, not pay, right? The dreaded, the hidden, the secret 3.8% tax. Like you have to understand, it's so interesting how our tax code is camouflaged, right? You've got a regular tax rate. Let's say you are a married filing joint making $500,000. You're going to probably end up paying about 30% in taxes, right? I think effective rate on the 500 is 25%. Okay, guess what? If your entity is not structured properly and you're sole proprietor, single member LLC, you're going to pay additional 15.3% tax on that. Guess what? If you have investment income coming into you, the government says, hold on a second, we're going to charge you extra 3.8% tax on that. You see what's going on, right? There's like these little additions, right? Little additions. And if you make over, I think, what is it, $250,000 as well, you get an extra Medicare tax of 0.09%. Like our tax code is so camouflaged. That's why it's really, really important for you to work with a tax planner. Every year, do not just prepare your taxes. If all your accountant does is preparing your taxes, I guarantee you, you are missing these little things that are in your tax code that even your accountant doesn't understand. You know why? Because when we preparers, right, and I say we because I used to be a preparer as well, when we input the numbers on the tax return, the software these days is absolutely amazing, okay? That software calculates, takes the income, bam, 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 calculates. If you do not make proper elections or proper selections or check the proper boxes on your tax return, the 3.8% tax will be applied to something that should not be applied on, okay? So your tax preparer, if you are especially an investor, you have investment income, like should be really, really smart, right? So you have to keep that in mind. So what are the things that you do not pay 3.8% tax on? Okay, first of all, you do not pay it on active business. Let's say, for example, you own an S corp, right? You take out a salary, blah blah blah. Now the S corp net profits $100,000, which goes to you personally. Okay, you do not pay tax on $100,000. Okay, why? Because it's an income from a business that you are actively participating in. Okay, that you're actively participating in. That could include partnership business. This could include S corporation. This could include self-employment. Okay, now it's also there's not net investment income tax on the wages. All right, as well. So something to keep in mind. Okay, so this stuff is easy, right? The softwares automatically know if you are marked as a passive, not passive owner of the business. It's not going to charge you 3.8% tax. Okay, make sense? Now, let's see what we can do on our taxes to actually intentionally and legally not pay this, right? Number one income that you will end up paying the 3.8% tax is on your rental real estate, which is the proper tax on that based on the tax code. But there are some of you on this call right now that are listening in, okay, that actually qualify as a real estate professional. right? That means it's an active business. And the IRS says if you are a real estate professional and you materially participate in your rental properties, right? And real estate professional, by definition of the IRS tax code, real estate professional means that more than 50% of your activity in your personal services that you do for the year is involved in real estate. You put in at least 750 hours in real estate, okay? And you materially participate in that property. So any income derived from that property generally would be subject to 3.8% net investment income tax, unless you check the box on your return to properly exclude the 3.8% that you are a real estate professional. Now, if you are in that category, you've got to talk to your accountant and say, hey, am I paying the 3.8% tax? And if you are, that's fine. There's a way around it. That's why that's called tax planning, right? You've got to make sure that you are doing tax planning for yourself. If you are that individual, you want to make sure you're not paying 3.8% tax, all right? So the first thing for you to avoid, the first way to avoid it, some of you, like I said, some of you might actually not qualify as a real estate professional by the IRS definition. But there are those of you that will and probably do qualify 100% and still end up paying the 3.8% tax if you do not make a proper election and a selection or a checkbox, whatever you want to call it, on your tax return. The second thing, oh, I love this one. All right. Number 2, short-term rental. Short-term rental. Okay. Generally speaking, you would think that rental real estate is passive income unless you're a real estate professional. Not so with short-term rentals. Generally speaking, short-term rentals are considered an active trade or business. Why? Because most of the individuals, I'm not saying all, most of the individuals that buy short-term rental property, they invest in that rental property, short-term rental property, but they also actively participate in it, okay? They make it their business. And 3.8% net investment income tax, the net tax, does not apply to your active trade or business, okay? Now, if you materially participate in short-term rental, okay, you've got a short-term rental going on, you materially participate in it, and it qualifies as a short-term rental on the IRS tax code. If, again, your tax preparer is not marking this on the tax return, right? I'm just going to make it like this, right? Doesn't put a checkbox on the tax return, guess what? You're going to be subject to 3.8% net investment income tax. Okay. Now, again, assuming that you are above these income thresholds, right? Obviously, we're talking about in the situations where you are, and most of you that are watching this video, because I'm producing content for business owners mostly, right, are in this or a much higher threshold. Okay. So that is really, really, really important. So if you own rental real estate portfolio and you do qualify as a real estate professional, if you don't qualify as a real estate professional, you should be planning right now what you can do for next year so that you can qualify as a real estate professional. First of all, it has its own great benefits. That's how the rich pay less or zero in taxes and not pay the dreaded 3.8, the hidden 3.8% tax. Okay. The second thing are short-term rentals. The third thing, okay, for those of you who know me, it's my favorite, self-rental. If you are renting to yourself, if your business rent a space from a property that you own, right? The money is going in, right? So let's just kind of do this. Business. We're going to put rental, right? You pay rent. Okay? Rent payments. And you over here now, you also report net income. Well, guess what? This net income by default in the tax software will be subject to 3.8% tax. Now, what do I say by default? Because when we enter information on tax return, look, it's so important for you guys to know what's happening in the background when accountants do taxes, right? Like when preparers do taxes, I know it because I've been a preparer. We receive documents, bam, 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 bam. We bang it out. We got no time. We've got tax season coming up. We're gonna end it up, bam, boom, bam. Hey, this is your tax bill, and the person's like, all right, I guess so, right? And then there's this. But if you were renting it to yourself and you just don't pick the right box on Schedule E, which is code 7, okay, for self-rental. And I've seen a lot of returns where that box is not properly checked. Well, guess what? It has its own, first of all, pitfalls for not checking that box. And it adds on, the software most likely will add on this extra 3.8% tax. Okay, self-rentals, no 3.8% tax. Short-term rentals, if you materially participate, it qualifies short-term rental, no 3.8% NIIT tax. Okay, and we said there is no NIIT tax on if you are a real estate professional. Okay, even if you are, there might be a NIIT tax on your tax. And why? Because most likely a proper checkbox is not checked. Ladies and gentlemen, I hope this was helpful. Remember, our tax code, even though our tax code is incentivized for business owners to invest more and make more money so that we can put back into the economy, create jobs, and those jobs, those people will pay taxes on that income that they receive, right? All of that is good. The tax code is incentivized, but at the same time, the tax code has all of these little taxes attached to it. If you don't know what you're doing, if you don't know, have a tax planner, okay? And I say this all the time, if you have a tax preparer, you do not have a tax planner, get strategy for yourself, create wealth for yourself. And you know what, how you can create wealth for yourself? The first steps to creating wealth is, first of all, cutting your tax bill. Okay, so I hope this was helpful. Let me know if you guys have any questions. Let me know in the comments below, and either my team and I will be happy to kind of assist you and answer those questions.